Sluggish economic growth has led to tax revenue undershooting estimates, with a shortfall forecast at $4.2 billion for the year ending March 31st. That's 10.8 billion rand more than the gap forecast in October. The government's effort to bolster revenue by raising levies on personal income, dividends, capital gains and value-added tax over the past 5 years have failed to arrest the debt trajectory. South Africa plans to reduce its corporate income tax rate of 28% over the medium term to boost the country's competitiveness as an investment destination among emerging markets. Corporate taxes account for 16% of government revenue. Elsewhere, Namibia retabled legislation banning the importation of dairy products and protects their dairy farmers from competition. Agriculture Ministry tabled the bill in the Namibian parliament, seeking to protect Namibian farmers who he said are hard hit by drought and need to be cushioned from rampant competition from outside. The import restriction legislation is meant to give the Namibia dairy producers access to their market without being hindered by cheap imports that will have access to Namibian shelves. The dairy industry is one of the key employment creators and sustains many farmers in the communal and commercial setup. Finally, the International Monetary Fund has said it has secured sufficient financing to provide $334 million in debt relief to Somalia, a milestone the bank said brought it one step closer to a decision on forgiveness of most of Somalia's $5.3 billion debt. Over 100 IMF member countries had pledged the financing, the lender said in a statement. The World Bank and the IMF said on 14 February that a final destination on debt forgiveness was possible by the end of March.